Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead at important events on the horizon. Let's start with what moved markets this past week, beginning with the powerful story that continues to drive growth: artificial intelligence. One of the most compelling themes in today's market remains the connection between AI investment and corporate earnings. As businesses expand their data centers and computing power, their earnings expectations are climbing. What's encouraging is that this improvement is being confirmed by real economic data, like a resilient job market and healthy company finances, rather than investor enthusiasm alone. For our portfolio, this supports the constructive outlook for both stocks and bonds as companies capture the productivity gains the AI cycle is creating. The scale of money flowing into AI infrastructure shows just how much room this trend still has to run. Hut 8 is looking to raise more than $4 billion to build a 352 megawatt data center in Texas, which is fully leased to NVIDIA. And this spending goes much further. Alphabet, Amazon, Meta, and Oracle have together issued more than $100 billion in debt this year to fund their own expansion. This tells us that AI is no longer just a technology story. It's a large economic cycle creating opportunities across construction, energy, manufacturing, and many other sectors beyond the biggest names in tech. Even with periodic geopolitical headlines, markets stayed remarkably focused on solid fundamentals. While negotiations in the Middle East created some uncertainty, oil prices eased and energy markets avoided the kind of lasting disruption that investors often fear. Combined with a resilient job market and healthy corporate balance sheets, this stability has helped investors stay confident. History shows that these periods tend to have limited long-term impact when growth stays intact, which is exactly why we keep our portfolios focused on the fundamentals rather than short-term news. Now let's look at what drove our performance over the past week and why we remain confident in our current positioning. Deere & Company was one of our strongest performers, climbing over 11% as investors grew more confident in its earnings outlook amid improving demand for agricultural equipment. Even in a tough farm income environment, Deere protected its margins through disciplined cost control and its leadership in smart, automated farming technology. We own Deere because its investments in automation and AI strengthen its competitive edge, while its exposure to construction and infrastructure adds valuable diversification across economic cycles. The information technology sector led our performance once again, powered by continued strength in AI infrastructure spending. Companies such as Qualcomm and ASML posted strong gains, benefiting directly from heavy investment by major cloud providers. While valuations remain above average, we believe the durable growth and strong balance sheets of these market leaders continue to justify our positioning. These aren't speculative bets. They're investments with companies with real competitive advantages and exposure to lasting trends. Our momentum strategy was the week's strongest performer, rewarding companies with rising earnings expectations, strong price trends, and clear execution. This leadership was especially visible in technology and select financial names, where demand trends remain healthy. We see this as a market that continues to favor companies with genuine business momentum, though we stay mindful of concentration and watch carefully for any shifts in the broader environment. Looking ahead, here are the key events that we're monitoring that could shape markets in the week ahead. Wednesday brings an important reading on U.S. inflation. Core consumer prices, which exclude food and energy, recently rose 0.4% in a single month, the largest jump in over a year, partly reflecting higher energy costs tied to the conflict in the Middle East. This matters because inflation shapes how the Federal Reserve thinks about interest rates, which influence the borrowing costs and the value of both stocks and bonds. Also on Wednesday, the Bank of Canada will be in focus after recently holding its key interest rate steady at 2.25%, taking a cautious approach given the global uncertainty. Encouragingly, the bank noted recently that higher energy prices haven't yet spread broadly through the economy, and it expects GDP growth of 1.2% this year and 1.7% next year. For our Canadian holdings, these decisions directly affect borrowing costs and growth, making this an important event for both sides of the border. Thursday brings the Producer Price Index, which measures the prices businesses pay. It recently surged 1.4% in a single month. This was the biggest increase since 2022, driven largely by a sharp rise in gasoline costs. This matters because the prices companies pay often flow through to the consumers later, giving us an early read on where inflation may be heading. As always, we remain focused on what matters the most: helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thank you for joining us, and we'll see you next week.